Shireen, let's dispense with the break and go straight away to our economists. We are joined by Samiran Chakraborty, the chief economist for Citi India, and Sajjid Chinoy, head of Asia Economic Research at JPMorgan, also a member of the PMEAC, of course. Sajjid, Samiran, thank you very much for being with us. Sajjid, you know, yesterday Anant Nageshwaran was very candid. He said you can't expect the government to cut fiscal deficit, add to capex, and do welfare spending. So what do you think they'll do?
That's exactly right, Lata. I think when there's so much clamor about stimulus, it's important to understand the macro backdrop here, that fiscal deficits are coming down. And I think the government's been very good about fiscal marksmanship. So, you know, when they say they want to have a deficit at 4.5% or below, I take them at their word. And I expect to see a 40 or 50 basis point of GDP consolidation. The question is, how will that be achieved? Right? Will that be achieved on the revenue side, or will that be achieved by rationalizing expenditures? And my sense is that, you know, with capex, the good news is December capex grew very strongly. So hopefully the undershoot in capex that had been feared for this year will be less than expected. But the capex story is an important one. I would expect for it to grow at least in line with nominal GDP. Right? So you want to ensure that capex to GDP is at the same ratio.
So 10% over 11.1.
Well, the 11.1 may not be achieved because I think despite a strong December number, the asking rate for the next 3 months is still 55% growth year on year to get to the 11.1. So we may be, you know, 10.5. But on that base, I think nominal GDP will grow at 10.5% like it has last year. So you'd expect to see capex grow at least 10.5%. This then introduces interesting trade-offs, because if capex to GDP is not falling, where will you get the reduction in the fiscal deficit? Some of it happens because other expenditures, defense expenditures, interest expenditures, don't rise in line with nominal GDP. Subsidies should not rise in line with nominal GDP. So there'll be some savings there. But the broader point is it involves trade-offs here, that if you want a tax cut as the market is clamming for, then some revenue expenditure has to be cut and vice versa. I'll make one final point. It's important at a time where there's been some slowdown in growth that we get maximum bang for our buck from the fiscal. And fiscal multipliers tend to be higher on the expenditure side than on the tax side. So really what you want is not to compromise expenditures that are going at the bottom of the pyramid, because those multipliers are higher. But these are the delicate trade-offs the budget will have to contend with.
Then you're clearly not the middle class's favorite, Sajjid. There is a lot of expectation.
I think a targeted tax cut is okay, but the space is limited.
I take your point. But no, Samiran, do you think Reserve Bank dividend can make a big difference? 2 lakh crore again is a reasonable expectation?
Yes, I mean, obviously, as we were discussing, Sajjid was mentioning that there are no free lunches. So clearly, somewhere you have to get an additional source of revenue from. In the last year's budget, RBI dividend provided that source. This year also, the number could be very large, and it could make a difference between these marginal changes that are expected in different things. Like, say, for example, we are estimating that the income tax cut or the tweak could be somewhere slightly less than 0.1% of GDP. So that can get carved out of that additional RBI dividend. Because the other source that economists have been suggesting for a while now, which is increasing significantly the divestment revenue, that does not seem to be the path that the government is walking because of certain market conditions. So that way, the scope for increasing expenditure or tax cuts gets limited. Yes, RBI dividend will definitely be watched very, very closely.
Samiran, they did not walk that path on divestment when the market was in the most charitable mood also, right? But that's a debate for another time, another day, perhaps. I just want to go back to that capex point and ask you, gentlemen, that, you know, they started the year budgeting it at about, I think, 3.3% of GDP, right? Now with the slowdown, maybe they end up at 2.9% or 3% of GDP. Going forward, while, of course, Sajjid has put forward the absolute expectations, the numbers for FY26 and, you know, 10% in line with nominal GDP growth, as a percentage of GDP, would you expect capex to continue to trend at those high levels of 3.3% or so, given what the economic survey is urging yesterday? Economic survey is saying, you know, the government has done its heavy lifting, its bit of the heavy lifting. It's time for the private sector to move up. Now, will that at all show up in the numbers in any way? Samiran?
So my sense is that the capex to GDP, public capex, central government public capex to GDP will not fall. But what is investors are increasingly looking at is exactly on what kind of things the government is spending. There is a perception that on the traditional sectors of roads, railways, defense, it's difficult to get that kind of high growth rates of 10 to 15% year over year, because there will obviously be some issues around whether the government will be execute them. So would there be some diversification of capex into other sectors like urban development, housing, R&D, water? That's one sort of a discussion. The other is that if the government is not doing divestment and PSUs are becoming stronger, would we see the PSU capex number to go up? If you recall, last few years, PSU capex have been coming off. This PSU capex has been going into the central government capex. So if we see the PSU capex number to go up, then the overall government capex actually will look much better.
All right.
Okay. You know, I have an overarching expectation. I mean, all of us have this economic policy framework. Samiran and Sajjid, the promise was that she's going to announce something now which will kind of, you know, cover for the medium term. What are you all expecting? Sajjid first.
Today is going to be outside the budget math. There's so much focus on the budget math, but the short point is fiscal degrees of freedom are constrained when you're reducing deficits by 0.5% of GDP. In fact, Lata, what you said, I think, are the more important elements. The July speech spoke not just about an economic policy framework, it spoke about working with the states on, on structural reforms. It spoke about reimagining the financial architecture. It promised a review on basic customs duties to rationalize import tariffs. It spoke about, making the income tax code, much easier to navigate. I'll be looking at continuation on that. And I would, I think the economic policy framework is important because this is the first year of a third term. We've seen overnight tariffs in the US may well go up on Mexico and Canada and China today on February 1st. The global environment is much more hostile. The economic survey spoke about that. So the framework will be a really important document to lay out a path for, in this global environment, how can India get 7% growth? Where should the policy emphasis be? One last thing I'll say, remember, we're forgetting that employment was the overarching objective of the July budget. And it'll be good to get a scorecard on how those employment-linked incentives and internships are done. Will those programs be tweaked? And what will be the budget allocation? So I think there's a lot of very important signals that will come in the budget speech outside of the fiscal math, which is much more constrained.
No, absolutely. We didn't hear anything about those employment. They were going to take up the EPFO and ESI part of some people employed under 15,000 rupees, etc. Though it's not been operationalized. But Samiran, economic policy framework, what should we expect?
So if I take the economic survey's main message to be the driving principle behind the economic policy framework, then it's clearly going to focus on deregulation. There is a huge positive externality that can come out of it. We have all talked about it in the past, but probably never in such a strong and clear way, that how important this is in driving productivity, not only productivity in general, but in particular, it affects the small and medium enterprises the most, who are trying to build up their businesses. And that's where it is also important to understand that the whole employment debate that Sajjid was referring to, that larger part of that employment happens in that space. Also, the fact that we often talk about India not being able to do as much labor-intensive exports and doing more of high-tech exports. Part of the reason could simply be that the cost of setting up business is so high that the lower margin businesses do not stay competitive. It is only the higher margin businesses which stay competitive. And that could be the reason why the economic policy framework would focus more on deregulation, ease of doing business, and that can cut across all factor markets, land, labor, etc.
All right. Gentlemen, thank you very much, both of you, Sajjid and Samiran, for joining us with that perspective as we head into the budget. But not a long wait now. Another 40 minutes and we'll have the budget speech, at least beginning. Now, 50 points on the Nifty, so it's kind of holding on, waiting for that. And we'll have more on the other side. Up next, we will connect with our voices from India Inc. Sanjeev Puri, Rajiv Memani, R. Mukundan, Vinayak Chatterjee. So they'll all be joining Shireen from the CII Budget Headquarters.